Hey everyone, welcome back to Gold Rush Reporter. I'm Hashir, your silver analyst, bringing you the real story behind today's precious metals market. If you've been watching the recent dip in silver and thinking the rally is over, think again. Because what we're seeing right now might just be the last fake out before one of the biggest breakouts we've seen in years. So stay with me till the end and don't forget to like this video, subscribe, and drop your thoughts below. I'd love to know whether you see this as a crash or a setup for something much bigger. Now, let's break down what's really going on. There are three main things to understand here, and the first one is simple. The fundamentals of gold and silver haven't changed. Despite what mainstream analysts are saying, the basic reasons people have been buying gold and silver for decades still apply today. The second key point is that the motivations behind these purchases are stronger than ever. And third, and this one's important, make sure you stay updated with real-time silver coverage. The truth isn't in the headlines, it's in the data. Now, about that recent silver fall everyone's talking about. No, it's not a red flag. In fact, this drop looks more like the final shakeout before a major surge. Central banks are in panic mode. Currencies are weakening fast, and yet most people still have no idea what's really unfolding. If you zoom out and look at history, you'll see this pattern before. It's the same setup that once triggered one of the biggest bull markets in financial history. Let's rewind for a second. Back in the early 1970s, gold went through a similar phase. It dropped sharply before exploding nearly tenfold in value. And right now, silver is following almost the same path. In October, silver prices touched a 12-year high, only to fall sharply soon after. The mainstream analysts rushed to declare the rally dead. But behind the scenes, something far more powerful is building. Central banks are dumping record amounts of US dollars. Meanwhile, silver prices remain absurdly low, a combination that historically signals an upcoming shift in wealth. You don't see setups like this often, maybe once in a generation. Silver is a fast mover. When it decides to run, it doesn't walk, it sprints. So the question now is, does this crash mark the end of the rally? Or is it the start of something much larger? From my perspective, this looks like the calm before the storm. Even gold's recent movements tell a story. Just look at how it jumped from $3,300 in August to over $4,000 today. If you had stepped away for just 2 weeks, you'd come back thinking you missed the biggest rally of the year. Sure, the past couple of days have seen some drops, but in context, we're still sitting comfortably above where we were a few weeks ago. These short-term pullbacks are just part of a much bigger bullish structure forming underneath the surface. And remember, markets love to shake out weak hands before rewarding patient investors. That's why it's so important to stay calm, stay informed, and keep stacking smart. This isn't the end of silver's story. It's just getting started. When you look at the bigger picture, this silver pullback is not something to fear. It's a reflection of how markets operate when pressure builds underneath the surface. Every time silver gets close to breaking a major resistance, the price gets hammered down. But what most people don't realize is that this isn't natural price movement. It's largely driven by paper trading and market manipulation from big institutions trying to control perception. They know the real demand for silver is off the charts, but they also know that as long as the public stays distracted by short-term dips, they can keep accumulating quietly at lower prices. Now, if you study the data, the numbers speak for themselves. Industrial demand for silver has never been higher. Solar panels, electric vehicles, batteries, medical equipment, all of these industries depend heavily on silver. In 2024 alone, global industrial demand hit a record high of over 600 million ounces, while mine supply fell short by more than 200 million ounces. That's not a small gap. It's a major imbalance that cannot continue indefinitely. Eventually, either the supply must surge, which is unlikely given declining mining output, or the price must rise to balance demand. What's happening right now is a tug-of-war between physical demand and paper suppression. Physical buyers, like central banks, private investors, and industrial users, are taking delivery, while paper traders on COMEX are pushing the price lower through contracts that never actually deliver metal. This is creating a strange situation where physical silver premiums are rising, even when the spot price is falling. That's a clear sign that the market is diverging from reality. And let's not forget the global economic backdrop. Inflation might appear to be cooling on paper, but the cost of living continues to rise in almost every major economy. Governments are drowning in debt, and central banks are trapped. If they raise rates, they crash their own bond markets. If they lower rates, they ignite inflation again. This trap is exactly why real assets like silver and gold are regaining attention. They are outside the system, real, tangible, and immune to default. When you connect all these dots, record industrial use, shrinking supply, rising premiums, and a broken monetary system, you begin to see why the recent pullback doesn't scare serious investors. It excites them. Historically, these are the moments when wealth quietly transfers from those who panic to those who prepare. And while mainstream investors chase tech stocks and hype tokens, the smart money is positioning in hard assets. Just like we saw in 2008, when markets crashed and metals surged after, the same pattern is forming again. Silver is undervalued, underowned, and underestimated. But that's exactly when it performs best. The coming months could be critical. If silver breaks above its key resistance levels, we might see an explosive rally that catches most people off guard. The fundamentals are aligned, the technical setup is tightening, and the sentiment is right where you want it before a breakout, quiet, doubtful, and ready to flip bullish in an instant. The question now is, who's ready for it? Another major factor that's quietly shaping silver's future is the role of central banks and their changing relationship with the US dollar. For decades, the dollar has been the dominant global currency, but cracks are finally showing in that system. Central banks around the world, especially in Asia, the Middle East, and South America, have been aggressively buying gold and reducing their exposure to dollars. This shift isn't random. It's a strategic move to protect their reserves from US monetary instability. And historically, when gold starts leading this kind of movement, silver follows with even more strength. In 2024, central banks bought more gold than in any year since the 1960s. That alone is a warning sign that confidence in fiat money is fading. But here's the interesting part. Smaller, more agile economies that can't buy gold at massive scale are starting to accumulate silver did instead. Why? Because silver acts as the poor man's gold. It provides the same protection against inflation and currency risk, but at a fraction of the cost. This quiet wave of sovereign and institutional buying is happening while retail investors are distracted, and it's building a foundation for something massive in the next few years. Now, let's talk about what's happening in the mining sector. Silver mine production is declining globally, even though demand is skyrocketing. Many large mining companies have already shifted focus to other metals like copper, zinc, and lithium, because they bring quicker profits. As a result, silver output has dropped by nearly 5% in the past year, the steepest decline in over a decade. Combine that with the fact that new mining projects are extremely difficult to finance in today's high-interest environment, and you get a long-term supply squeeze that's almost impossible to reverse quickly. Meanwhile, recycling, which often helps fill gaps in silver supply, is also down. Many households and industries already sold off their scrap silver during the last price spikes. So now, with inventories being drained and new supply limited, we're looking at one of the tightest physical markets in modern history. This kind of setup doesn't stay quiet forever. It eventually erupts, usually when one unexpected event exposes the shortage. Another signal of what's coming can be seen in the gold to silver ratio, which currently sits around 80-1. Historically, that's extremely high. For context, during previous bull runs, that ratio compressed to as low as 30-1, and in ancient times, it hovered near 16-1, roughly the natural ratio of these metals in the Earth's crust. What that tells us is simple. Either gold is overvalued or silver is massively undervalued. Given what's happening globally, it's much more likely that silver is the one waiting to catch up. Every major shift in financial history begins quietly like this, slowly, under the radar, while the majority focuses elsewhere. But when sentiment flips, it does so violently. Once investors realize that silver isn't just a shiny metal, but a critical industrial and monetary asset, the repricing will be rapid and dramatic. That's why understanding these early indicators is so important. Because when silver finally breaks out, it won't give anyone time to react. Now let's focus on what's really happening behind the curtain. The financial system's structural stress. That's starting to show up in the bullion markets. The London Bullion Market Association, LBMA, which is one of the largest clearinghouses for physical silver, is facing a severe chip liquidity and supply crunch. Physical silver inventories are being drained faster than they can be replaced. For over 3 consecutive weeks, silver has been in backwardation. That's when the spot price, the price for immediate delivery, is higher than the futures price. This situation is extremely rare, and it's a strong signal that the real physical demand is overwhelming paper supply. Normally, futures trade at a premium because of storage and insurance costs. But when the opposite happens, it means buyers want silver now, not later, and they're willing to pay extra for it. That's not a healthy sign for the system. It's a warning flare that something fundamental is breaking down in the supply chain. Adding to this tension, the lease rate for silver. Basically, the interest charged for borrowing silver has surged to nearly 40%, and the cost of borrowing SLV shares, the major silver ETF, has also skyrocketed. When borrowing costs jump like that, it usually means there's a shortage of available metal. In simple terms, those who need silver can't easily get it, and those who have it are holding on to it tightly. Meanwhile, commercial banks. The big players who usually control the short side of the silver market are starting to get nervous. They've been betting against silver for years, using futures contracts to suppress prices. But this time, they're cornered. Managed funds and retail investors are accumulating long positions, and if silver spikes sharply, those shorts will be forced to cover at higher and higher prices, triggering a full short squeeze. When that happens, price movements can be explosive and fast. Another layer to this situation is the May political narrative, emerging around precious metals. Figures like Judy Shelton and even Donald Trump have been openly discussing the idea of reintroducing gold-backed currency, or remonetizing real assets. While that may sound far-fetched to some, the fact that this conversation is happening at all in mainstream circles is significant. It shows that confidence in the fiat system is eroding, and that people are beginning to look toward tangible, limited supply assets like gold and silver as anchors of real value again. Even Wall Street giants are changing their tone. Morgan Stanley recently recommended that institutional clients hold 20% of their portfolios in gold, while Jeffrey Gundlach, one of the world's most respected bond investors, said that a 25% allocation to gold isn't overweight anymore. Think about that. A quarter of a professional portfolio in gold. That's unheard of in modern times. When people at that level are preparing for instability, you know something major is on the horizon. The writing is on the wall. What's happening right now in the LBMA and futures markets is not just about silver. It's a reflection of systemic stress across the global financial structure. The leverage, the debt, the derivatives, they're all connected. If one part of the system, like a major bullion bank, fails to deliver on its silver obligations, it could trigger a domino effect through credit markets, commercial loans, and even the broader banking system. That's why smart investors are quietly repositioning now into silver, gold, and other hard assets, while the majority still believes everything is fine. Because when confidence cracks, it happens all at once, and the rush to safety becomes chaotic. The question is, who will be prepared when that moment comes? As we reach the end of this deep dive, it's clear that the silver market isn't just reflecting investor sentiment. It's revealing the cracks in the global financial foundation. What we're witnessing right now at the LBMA is not a routine liquidity event. It's a signal that the paper silver system is running out of real physical metal to back its promises. For weeks, we've seen backwardation persist, lease rates explode, and borrowing costs skyrocket. These are not normal conditions in a healthy market. They are the symptoms of an industry stretched to its breaking point. When spot prices stay above futures for this long, it means investors and industrial buyers alike are desperate to secure physical silver today. Not contracts, not IOUs, but actual metal. This stress isn't isolated. It ties into the broader web of our derivatives, credit markets, and institutional risk. Big bullion banks don't just deal with precious metals. They're deeply connected to commercial loans, real estate portfolios, and global debt markets. If even one major player fails to deliver on its silver obligations, the ripple effect could travel through the entire financial system. It would be like pulling one card from the base of a massive house of cards and watching the rest collapse. At the same time, we're seeing a major psychological shift in how the world views money. Leading financial minds, from Harm Jeffrey Gundlach to strategists at Chase, Morgan Stanley, and Bank of America, are openly calling for pound 20-25% portfolio exposure to gold. When the largest institutional investors start admitting that fiat systems are losing credibility, you know that confidence in paper assets is fading fast. This movement toward real money, silver and gold, is not some passing trend. It's a reset in thinking. And as I've said before, every financial storm in history has ended the same way, with people returning to assets that hold intrinsic value, the kind you can touch, weigh, and store. The kind that doesn't need a counterparty's promise to be worth something. Silver, in particular, is in a unique position. It's not only a monetary metal, but also a critical industrial resource. As supply continues to tighten and new technology demands keep rising, we're approaching a point where scarcity meets necessity. That's when price discovery becomes real. Not dictated by paper contracts, but by physical availability. And that's why I believe what's happening right now is historic. It's not just another market move. It's part of a much larger shift. The slow, steady remonetization of real assets. When the dust settles, silver might finally reclaim the role it once held, not just as a commodity, but as true money. If you've been following this channel for a while, you already know the signs have been building for months, but now they're impossible to ignore. The system is showing its limits, and those who understand it are quietly preparing for what comes next. This is the time to stay informed, stay grounded, and think critically. Don't follow the noise. Follow the signals. Thanks for watching today's deep analysis here on Gold Rush Reporter. If you found value in this breakdown, make sure to like this video, share it with other silver enthusiasts, and subscribe to stay ahead of the curve. Because in times like these, knowledge isn't just power, it's protection. This is Hashir, your silver analyst from Hadsia, Gold Rush Reporter. Signing off, until next time, stay smart, stay prepared, and keep stacking.